If your lifestyle keeps going up, but your investing doesn't, baby, your retirement is in trouble. You cannot outwork lifestyle creep with a 401k alone. That purse, that house, those trips, beautiful. But if your investing isn't going up at the same rate, oop. So today, I'm going to tackle how you need to handle your investing when it comes to lifestyle creep. I'm Dakota Grady, DG the Money Coach, and I'm all about helping you to master your finances. You're used to getting a raise or a bonus every year. Do you normally raise your level, your lifestyle the same when you get that raise? 100%? 20%? Like, what's your raise in terms of your lifestyle when you get that money increase? Drop in the chat below. Here's what you need to do if you have a problem with spending and have a lifestyle creep when it comes to making more money and when it comes to investing. So here's what you need to do. The first thing you need to do is think about investing first, lifestyle second. Your investing, your retirement is important. You can depend on the government through Social Security or Social Insecurity. Some people think that there won't be enough money for, say, Gen X or Gen Z because the boomers are going to take all the money out when they retire. That's not even an option some people may think about. It may depend on your savings account. Not an option either because saving is different from investing. Investing is going to grow your wealth. It's going to grow and give you earnings, whether it be dividends through stocks or interest through bonds. The whole point is savings don't grow as fast as investing. Your saving account won't do it, won't cut it. And then if you have nothing saved, that definitely won't cut it. So you need to make your investing a priority and think about it. Why wouldn't you want to invest? It's your future. Pensions are basically disappeared unless you work for state government. Maybe you work on the police force, firefighter, maybe you work for the county. My wife worked for the county for like 5 years when we lived in Tennessee. And it was basically, she had a cake job. I mean, once you're in the door, you're there. And it's that simple. So you keep your job, and it was like had to worry about it because you got a pension. But if you don't have a pension job or a job that gives you a pension, it's up to you to invest for your retirement. And you can spend now, enjoy life, but not think about the future. And then when you get to the future, you're struggling and working at Wiley World or working at Dollar General, making low wages because you didn't prepare. So think about investing first, and secondly, lifestyle. It's important to have money in your life, but you want to put things in perspective. You want to prioritize investing over your lifestyle increase because, again, you can enjoy life, but not to the extent that you want to in the future. So imagine if you are investing now, you're putting lifestyle creep on hold, and you retire, and you have enough money to really enjoy life and not worry about lifestyle creep because you got enough money to fund the lifestyle that you really wanted. That's why I'm trying to help you understand. Invest first, lifestyle increase secondly. Second thing is, I recommend investing 10% to 15% of your income in retirement, for retirement. I recommend doing a Roth IRA. Here's why. Because a Roth IRA allows you to invest money with after-tax dollars. So what I'm saying is you invest money that has already been taxed, then your money grows over time. So when you take money out of the account, it's not taxed. So for example, if you are in a, say, 10% tax bracket right now, and you retire, and your income has significantly gone up, so you're in the highest tax bracket, and I think about 37% for tax brackets right now, you will pay a lot in taxes. If you're investing 10%, 15% over time, 15, 20, 30 years, you should be all right paying taxes. So I recommend to invest 10%, 15%. In fact, when you invest with the Roth, it's not taxable. Now, if you do have a 401k or a traditional IRA, you're investing with pre-tax dollars, meaning you're investing money before taxes are taken out. And when you withdraw money from retirement from your 401k or your traditional IRA, the money will be taxed at that 37% tax rate, which I mentioned earlier. So the whole point is make sure that you invest. And if your job has a match, invest up to the match. And if they don't have a match, still invest. The whole point I want you to do is to invest. And the third thing is evaluate if you're hitting your goals for retirement. If you're doing that 10%, 15% for retirement, and you feel like you aren't at your goal, you feel comfortable enough to say in 20, 30 years that you'll have enough saved for your retirement, ramp it up. Meet your advisor and do anything that you can to increase your contributions up to the limits. And maybe even if you want to invest in a brokerage account, that's a different topic, but a brokerage account is another option for you to invest and increase your retirement savings. So again, if you do get a raise or bonus, I recommend you're meeting your goals when it comes to retirement. I recommend, say you make $200 or $300 extra for a bonus. Spend 50% on investing, invest an additional 50% out of the bonus or the raise, and the other 50%, do lifestyle increase. If you want to, or you can do your own numbers, but the whole point is you can split the difference, half of investing, half for lifestyle creep. That way you can satisfy both needs and not be so restricted to just investing or so loose and just go out and just spend all your money and splurge on lifestyle increase. Save this video so you don't forget, and I'll see you in the next video. I'll see you there.